shoot your questions over that way. But guys, before we dive in, I got to get something off my chest. I've been scrolling through social media, and I mean, politics aside, I can't believe some of the reactions to what's going on. It's crazy out there. Everybody seems to have an argument and an opinion, but few people are offering answers. So it's interesting. But after a few minutes of watching people just vent, I do have to move along. But one thing I want to point out that kind of stirred me up is I am so exhausted by the catchphrases in real estate, right? And a couple that we continually see jump out there is marry the house, date the rate, right? And I get it. I understand the premise of that. They're trying to encourage people to look past the interest rate, which by and large, I believe we've become adjusted to the current interest rate environment. But the strategy behind that comment is refinance in the future when, and I don't like the word when, rates come back down, because the same group of economists and soothsayers and crystal ball readers who are predicting rates are going to end the year somewhere in the fours are the very, very same people who told us last year they weren't going to go past, what was it, 3.75? I think that was the number. I posted it to the Facebook group. But my point is we blew past 3.75, blew past 7, pulled back to the mid-sixes, and we've been bouncing around ever since. So this is all just conjecture, just, prediction, just not smoke and mirrors. I think they're genuinely well-intentioned, but the economy clearly has been unpredictable. So that idea of when rates come back down, we don't know if that's going to happen. And I don't like the idea of the 3-2-1 buy down unless you plan on selling the home in a short period of time, because guys, that 3-2-1 buy down is an amazing tool in the right hands, but you've heard me talk about tools before. A hammer is a tool that you can build a house with, but you can tear a house down with. So that 3-2-1 buy down lowers your payment by 3 full interest rate percentage points. So a 5.5 rate goes down to 2.5, and that's a big monthly savings for the first year. And then it steps up 1% year 2, an additional percentage point in year 3, and then goes back to where it started. I'm not a fan of adjustable rate debt because I saw what payment shock did to the average consumer during the housing crisis. The housing crisis was driven by very speculative debt and very cheap money. And it wasn't cheap because the interest rates were 2%. It was cheap because they started low with adjustable rate mortgages, but they had an interest-only component, which made it even falsely cheaper, if you will. I don't know if that's a proper phrase, but once the payment started to adjust, people couldn't afford the properties, and there was a load of speculation, none of which we're seeing now, by the way, guys. This isn't a prediction of anything to come, but when those payments started to adjust and people owned 5 or 6 or 7 homes, they were forced to sell the properties, and that's what triggered all of the inventory coming to the market. Then that easy free money went away and people had a difficult time qualifying. But my point in that is that payment shock, that adjustment is what triggered it. Because guys, if you qualify for a home and all of a sudden your payment's $500, $600, $700, $800 less, well, we know what human nature does. We expand to the space. Well, what is that old adage about a goldfish or a plant? It's going to grow as big as the pot will allow it to. Most people will do the same thing with their debt. So if all of a sudden they've got an extra $500, $600, $700 a month, well, there's probably going to be a jet ski in the garage, or maybe a new car or a motorhome. So what happens when those payments start to adjust? You're not prepared for it. So I'm not a fan of kicking the can down the road. I'm a huge fan of a permanent rate buy down. I think that's a brilliant strategy, because if the rate is, I don't know, let's pick a rate of the day, 6.25, right? I don't know. And you can buy that down to 5.25, it stays there for the life of the loan. So if rates never come back down, good on you. You've saved the entire time. Now, if rates do come back down in the future, you certainly can refinance if you find it in your best interest. But I don't like that refinance being part of the strategy, because none of us know where rates are going to go. We can look at the daily data, we can see trends, but none of us are predicting accurate. But I haven't seen anybody accurately predict this economy in the last few years. So anyway, I wanted to get that off my chest. The other one is rent is 100% interest. That drives me nuts, because rent is not 100% interest. And I get what they're saying, right? Rent, again, they say you're throwing your money away. No, guys, people need a place to live. Yes, owning your house is definitely the right move if it makes sense for you financially. If you're at the right place in your life, you're building equity, there are tax benefits. I understand the premise of that saying, that catchphrase, right? There's not a net benefit other than the right to live in that house to the person, but not everybody's always ready to rent. And sometimes, not always, sometimes renting makes more sense. I had someone call me this week. They have the opportunity to buy a unit in the building that they've been renting in for years. Now, here's the interesting thing. The rent's only $1,200 a month, and the landlord hasn't increased it. Well, this is a single mom whose friends have been encouraging her because rent's 100% interest. She's got to go buy something. Well, a unit popped up in the building available. It's $235,000. Now, in her defense, she just assumed, hey, if I'm renting for $1,200, I should be able to buy it for $1,200. Not so fast. With a 3.5% down payment, assuming FHA is approved that condo already, because FHA hasn't approved every condo, and there is a process. Her mortgage payment would be $1,950 a month. That's including principal, interest, taxes, insurance, mortgage insurance, and the homeowners association. Now that's $750 a month more than she's paying rent. So some could argue that she's going to gain appreciation, and it makes sense if she's able to buy a $235,000 property. Or does it make more sense in this instance? And I don't have the answer. Everybody's an individual. But after 12 months, she would have had $9,000 in savings with the $750 a month that she is saving each month from that lower rent payment, plus that original $8,200 down payment. So $17,200 to the plus. And if real estate appreciates at 5%, that's, I don't know, $11,000 in appreciation. You tell me where that balance is. So rent is not always bad. It's not 100% interest. I understand it, but I'm not a fan of catchphrases.